Hello, everybody. And this is the very last topic we are going to cover in this course. So welcome to topic 12. Topic 12 is like a wrap up or wrap down topic where we are going to have a look at tax avoidance and tax evasion. And before that, I will probably talk a little bit about tax planning, just give you an overview of that. And then we will have a look at tax avoidance and tax evasion issues, and particularly in knowing how to differentiate them. And then I actually pick up one of the tax cases to go through with you all, because that is a pretty interesting case as to whether that sort of arrangement is regarded as a tax avoidance arrangement or not. All right, and then I will have another look at a simple example, which is provided by the Inland Revenue, to give you their views as to whether, again, that common type of situation is regarded as a tax avoidance arrangement or not. Okay, so that is what we're going to do today. Okay, so coming to tax planning first, I think from the very beginning, I did mention that nobody wants to pay more tax than they have to. And for other taxpayers or investors, if they have income, right, they'll be pretty interested in paying the minimum amount of tax. But they should also always bear in mind that when they're looking at minimizing their tax liability, it should be done within the confines of the tax legislation. So it must be something which is allowed by the Income Tax Act, and not something which is against the act, right? So that's the very first point here. And we'll talk a little bit about this later on as well. When we look at tax planning, normally there are two broad considerations involved. The first part is about people wanting to know what are the tax consequences or implications in implementing a particular transaction or an anticipated event. So people have different types of transactions that they might want to go into. And I'll just name a few examples. For instance, if somebody who is in business, they might think about whether they want to buy an equipment for the office to use, or maybe they want to lease the equipment instead. And those are choices that they can make. And they will be interested from the tax point of view as to what are the tax consequences if they actually own the equipment or if they actually lease the equipment. Other good examples of events or transaction could be even like in the case of an employer, if they want to provide an employee with a motor vehicle to use, they might also want to think in terms of whether they should buy the car, right, and then let the employee use, or should they actually ask the employee to provide their own car, right, and then maybe claim whatever expenses that is used to carry out the employment duties. So again, there is a choice there. And the choice has a different income tax consequences. And I can think of many different examples which have choices and which will have different income tax consequences, including like in the case of companies, right? When they want to finance their business, they have the choice in terms of whether they want to raise a debt or they want to raise by means of equity. And the income tax consequences are very different as well. So for somebody who doesn't have much tax knowledge, so normally they will go to a tax advisor or a tax expert who will help them to go through the different tax consequences. And then from there, they might be able to make a decision as to which is the better way for them to go. All right, so that's what this first part is all about. The second part is looking at what is the structure to use for the business. And we have covered business structure over 2 weeks. So you might have somebody who wants to start a business and not so sure as to whether they should incorporate the business, or should they use a trading trust to run the business, or should they operate in a partnership, so on and so forth. Right, so again, the income tax consequences are different for different business structures, and they might need to seek the help of an advisor to go through the income tax implications, and from there arrive at a decision as to which is a better structure for them. So it's not only those who are planning to start a business, it could be also be those who are already in business, and they might want to think about whether their existing structure is suitable for their current situation or not, right? So again, they might seek the advice of a tax expert who might go through the tax implications with them. So that's what tax planning is all about, knowing the tax implication or tax consequences of a particular transaction, or if they want to structure or restructure, right? What are the tax implications? Now, I've also shown you this slide before. At the very beginning, when we talk about tax planning, it actually boils down to how the tax liability is being calculated. So we always need to know what is the income for the year, what are the expenses that can be claimed in that year, are there any losses made by them, what is the tax rate of the particular taxpayer, and then from there, you're able to work out the tax liability. And then if they are entitled to any credits, we deduct the credits. Now, as you can see from this framework, tax credits and deductions are actually very different, right? So I'm just more or less pointing to the assignment 2 that you all did, where one of the questions asked about deduction, and a lot of answers were actually pinpointing credits. And the one that I was referring to is about donation, right? So as you can see from this slide, a deduction and a credit, they are totally different, right? Deduction is whether the expense can be claimed to reduce your gross income. Tax credit or whatever other credits is claimed after you work out the tax liability, right? So they are totally different. But anyway, for tax planning purposes, people will be thinking in terms of, just by looking at how tax liability is being calculated, is to think in terms of, or look at strategies which can help them to minimize their tax liability. Are there ways in which they can reduce their income? Are there ways in which they can maximize the claim of deductions? Are there ways in which the tax can be taxed at a lower tax bracket? And are there ways in which they can alter the timing of the flow of income and expenditure? Now, the first 3 will help a taxpayer to reduce their tax liability. The 4th one actually doesn't. What it does is it might help to improve the taxpayer's cash flow, right? But over a period of time, the total amount of tax to pay normally will be the same. But people normally like to claim as much expenses as possible in the earlier part than at a later part, right? So that helps them to improve their cash flow. It's just a matter of altering the timing of the income and expense. But over a period of time, the total amount taxed or the total amount that's claimed is actually the same. All right, so just to make that point clear about that, some examples of a tax planning will be looking at how a taxpayer can divert the income or divert the losses, so another person can actually claim the loss against their other income. And we have gone through business structure, and I just pick up an example in the case of those who use a look-through company to run their business. And if the business makes a loss, if the LTC makes a loss, you find that under this particular structure, the losses actually flows through to the owners of the LTC, and they can actually use it to set off against their other income, right? So this sort of structure allows that sort of possibility. Whereas if it's just an ordinary company, the losses cannot flow to the individual shareholders, it can only be carried forward. So when people think about what structure to use, if they think that they're going to make losses based on their calculations in according to the Income Tax Act, then they might want to look at a structure that allows them to claim the losses, allows the owner of that structure to claim the losses. I've also gone through a grouping of losses for companies. If they have brothers or sisters company, you find that the loss of one company can be diverted, right? Or it can be claimed by another company within that 66% group. A more common way of thinking of how to reduce the income tax liability is to look at how they can split the income, right? So split the income means passing the income to somebody else who is at a lower tax bracket, and that means they'll be able to save some tax. And a business structure, different business structure might offer that opportunity. And I've gone through with you all on the different business structures, because a corporate structure is taxed at a flat rate of 28%, whereas other structures like individuals or partnerships, they are taxed at their individual marginal tax rates. Whereas if it's a trading trust, it really depends on whether it is trustee income or beneficiary income, and whether the beneficiary are at a lower tax bracket. And another common way for them to split income, as I mentioned in the earlier topics, is they will go about by employing their relatives, right? Maybe they can bring in their spouse to help in the business and pay them some salary, right? So that is already one way of splitting income. Another way would be thinking in terms of really permanently transfer income producing assets to others. So if somebody, for instance, owns a rental property, and if they're already at a very high marginal tax rate of 39%, then whatever income, net rental income they get will be taxed at 39%. So one way of going about that is to actually permanently transfer the rental property to somebody else who is at a lower tax bracket. And a trust could be used, right? Because you know that even though the top marginal tax rate is 39%, the government hasn't increased the trustee rate yet, right? I don't know whether in the future years they will do that. They're actually monitoring people's situation to see whether people are trying to avoid the 39% bracket or not. But anyway, at the moment, the trustee rate is at 33%. So if the assets, these income producing assets, are transferred to a trust, and even if the trustee does not distribute the income to the beneficiaries, the trustee are taxed at a rate of 33%, right? So that already gives us a savings of 6% tax, right? So in this case, the assets are actually permanently transferred to the trust, meaning that now it is the trust that actually, the trustee of the trust that actually owns the property. Now you all have covered this property relationship act, where couples can actually come into an agreement to transfer property to one another. And the Income Tax Act is quite favorable to those type of transfer if it is made under a relationship property agreement. So initially, you might have the husband who is owning a lot of property, and those property are income producing, and he's already at a very high marginal tax rate of 39%, and his spouse does not have much other income, and she's at a lower tax bracket. They can enter into an agreement where the husband could actually transfer some assets to the other spouse, right? So that is also a permanent transfer of the property. And for income tax purposes, when that happens, there is no income tax consequences. It's looked upon as if the other spouse stepped into the shoes of the original owner. So it's until the spouse that actually dispose of the property to somebody else that it will trigger income tax consequences. And this is an example that illustrates that. So if we have A and B who are married, and they have A has probably more property than B, and they come to an agreement where A is willing to transfer some of the income producing assets to the spouse B. And normally they will do that if they are, well, in a stable relationship as well, all right? Otherwise, you find that one party might be unwilling to do that. So let's say we follow this example. A is going to transfer her shares to B, and we are told that, remember when we covered personal property, we have section CB4. If somebody buys property for the purpose of resale, then you find that when they sell the property, it will be subject to tax. So this is just giving you the scenario, the extra information that these shares were actually bought for resale purposes. But anyway, it was transferred to the other spouse, and let's say the cost of the shares were $30,000. So let's have a look at the income tax implication for A. It is transferred under a relationship property agreement. A is the transferor. For tax purposes, it will deem to be transferred at cost to B. So that means that if you work out the transaction, originally it cost $30,000 and transferred at $30,000, well, there's no income, right? Income is zero. That's what we meant by there is no further tax consequences when such a transfer of assets is made under a relationship property agreement. Therefore, B will deem to own the shares at a cost of $30,000, and until B sells these shares to somebody else, that it will trigger income tax consequences. All right. So let's say if B later on sold it for $40,000, then the gain is $10,000. Is caught under section CB4 because those shares were bought for resale purposes, and B will be taxed on the gain of $10,000. Right, so that's just an example to illustrate this scenario when property is transferred under a relationship agreement. Now, next, we're going to move on to a differentiate between the terms that people use when it comes to a tax planning. When people talk about tax minimization, normally we look upon it as a legal. That means it is done within the limits of the law, or within the means of the law, or within the confines of the law, right? So it is legitimate. You're looking at it as being legitimate, and normally they are made in the context of commercial and family situation. And we'll go through some examples afterwards. Now, you also come across the term tax avoidance. Tax avoidance is actually legal. It's not illegal. People can avoid tax, but then within the Income Tax Act, the Commissioner of Inland Revenue has the power to counteract such types of certain types of tax avoidance arrangement, right? So we're going to have a look at some examples afterwards. And there are two types of tax avoidance within the Income Tax Act. One is called the general tax avoidance rules, and the other one is the specific tax avoidance rules. And the other extreme is tax evasion, right? Tax evasion is totally illegal, right? So tax minimization is acceptable. Tax avoidance is legal, but it can be voided. Tax evasion is illegal. Some examples of tax evasion is provided in the, this is the Tax Administration Act, right? This is not the Income Tax Act, this is the Act under TAA. Tax evasion may involve somebody who intends to evade the assessment or payment of tax. So if somebody does not declare the income which is taxable, right, and they know that it's taxable and they did not declare the income, then that is tax evasion, and that is illegal. Somebody obtaining a refund or payment of tax, they're not lawfully entitled. Well, probably they falsify some documents to claim some refund. Knowingly doing that, that's also regarded as tax evasion. Somebody who is using deducted or withheld tax for anything other than its lawful purpose. So if somebody has collected PAYE from the employees' salaries and did not pay over to the Inland Revenue, that is also tax evasion. Or somebody who knowingly does not make a required deduction. Again, employers are obliged to deduct PAYE, and if they purposely, right, or knowingly did not deduct them, it is also tax evasion. Or if they are supposed to withhold tax, like those who have to deduct resident withholding tax in advance, and they don't do that, that is also tax evasion. So these are some examples of what we meant by tax evasion, and it is illegal. Now, very common examples of tax evasion will be people who are involved in the cash transactions, because it's quite difficult to detect people who receives their sales or takings in cash. And it does happen in a lot of practices where people actually do not fully account for the cash takings. But if the Inland Revenue in their audit, and if they spotted such situations, it will also be regarded as tax evasion. Like in this case, taxpayer mainly has cash sales and always take out some money from the till and only bank in the remainder. So in this manner, this taxpayer is actually under declaring the income, right? Knowingly under declaring the income, and this is regarded as tax evasion. Or if somebody who deduct the PAYE from the employee's salaries and did not pay over to the Inland Revenue, but just pocketed them, that is also regarded as tax evasion. Right, as I said, tax evasion is illegal and the penalties are really harsh. There are two types of penalties that can be imposed on a tax evasion. One of them, which is termed as civil penalty, right? If you want to read a bit more, they're all in Anxiety, which will impose percentage of fine depending on how serious the evasion is, right? So it can be up to the highest, which is 100% of the amount of tax evaded, right? The lower part is up to 20% of the tax evaded, and it goes up to 100% depending on seriousness. Now, the court can also say, well, this is a crime, right? So people who evade tax, they can also say it's a crime. If it's judged as a crime, then criminal penalties may be imposed. And criminal penalties are even more stringent. In some cases, well, the judge has the right to say that, well, the person has to serve a certain number of jail terms, right? So under knowingly fail to keep records, for instance, right, there are fines involved, including jail terms. Some others, like providing information to Inland Revenue, that there's no jail terms for that, or obstruct Inland Revenue to carry out duties. There are some penalties, but there are no jail terms, right? Knowingly evade tax, the judge has the right to impose a jail term on the offender, right? So we have civil penalties and we have criminal penalties as well. That is for tax evasion. Now, tax avoidance. Tax avoidance is a more complex area because, as I said, tax avoidance is legal, right? It's not illegal, it's legal, but the act will allow the Inland Revenue or the Commissioner of Inland Revenue to adjust the amount if they think that it is a tax avoidance arrangement. So I'm going to go through some of the terms that they use in the tax avoidance within the Income Tax Act. As I said, there are two main categories of tax avoidance. One of the categories is termed as a general, right? There's a general anti-avoidance rule. And we have another category which is called the specific anti-avoidance rules. And we'll just look at the key principles and themes. So the specific anti-avoidance rule, there are numerous of them within the Income Tax Act. And we have specific ones for different regimes. Even like a fringe benefit tax, right? There is a specific anti-avoidance rule on fringe benefit tax and many others, right? So it's specifically pointed out that applies to a particular regime. This is a general one, right? The general one allows the Commissioner of Inland Revenue to adjust if the arrangement is void, and this falls under the general anti-avoidance rules. Let me just pick up a few examples of specific anti-avoidance rules. We're not going into too much detail, but we have actually gone through two of the rules when we covered topics on deductions as well as a business structure. So I've already brought to your attention about excessive remuneration paid to relatives, whether it is by a sole trader or by a partner in a partnership or by companies, and whether the company is a closed company or not. So we have two main sections, GB 23 and GB 25, which we have already covered, are actually the specific anti-avoidance rules, right? So it is just to close the loophole, right? To make sure that these people do not pay salary excessively. That doesn't reflect the market value. And it allows the Inland Revenue to step in to adjust the amount of remuneration to reflect the market value. So that's what these specific anti-avoidance rules are all about. And we're not going to go through all of them, right? So these two is good enough. If you want to know more, you can read them up in NZT. Now, the general anti-avoidance rule is the one that most taxpayers or the advisors are more worried about, because it is not that straightforward, right? You actually have to look at the facts of the case to see what is actually going on there. what sort of arrangement have they come out with? And will that arrangement be considered as a tax avoidance arrangement? So we have section BG1 that says, if they see that it is a tax avoidance arrangement, it is void against the CIR for income tax purposes, and the CIR can counteract the tax advantage that the person has obtained under that sort of arrangement, right? So BG1 gives the Commissioner of Inland Revenue the power to adjust the income, right? Which actually counteracts the advantage that they obtain from that arrangement. So it becomes very important to know what is actually a tax avoidance arrangement. Well, it is also defined in the legislation. It is an arrangement that directly or indirectly has tax avoidance as its purpose or effects, or has tax avoidance as one of its purposes or effects, whether or not any other business or effect is referable to ordinary business or family dealings, if the purpose or effect is not merely incidental. There is a lot to take in. And they have also defined arrangement. Arrangement refers to whether it's an agreement or contract, a plan and understanding that is all under the umbrella of the term arrangement. Now, in practice, normally when cases crop out as to whether it is a tax avoidance arrangement or not, in many cases, it comes under this category. Because in practice, when somebody arranges their tax affairs in such a manner, it normally have a number of purposes, right? And YA1 says that as long as tax avoidance is one of the purposes, and as long as the benefit that they derive from that arrangement is not merely incidental, then it will be caught under this section as a tax avoidance arrangement. So we have this term tax avoidance and merely incidental, how we actually interpret them. Well, tax avoidance is also defined in the legislation. You find that they have defined all these terms separately. And this is the scary bit, because it is broadly defined, and it says that tax avoidance includes directly or indirectly altering the incidence of income tax. So what they're saying is, if initially the person derives some income and therefore have to pay tax, the incidence of the tax or the burden of the tax is borne by that person. So if somehow it gets shifted and it is borne by somebody else, so that's what is meant by altering the incidence of income tax. Instead of they bearing the tax, somebody is actually bearing the tax. It can be regarded as tax avoidance. Or if somebody directly or indirectly, where it relieves any person from liability to pay income tax. So this is also like diverting the income to somebody else, right? So initially, instead of them paying the tax, they relieve themselves from paying the tax. It is somebody who is paying the tax now. That is also within the definition of tax avoidance. Or directly or indirectly avoiding, reducing, or postponing any liability to income tax is tax avoidance. So the way it's being defined, when I say it's quite scary, is anything you do, even within the income tax provision, sounds like it is tax avoidance. So it tends to be, you think about it, sometimes it tends to be quite contradictory, because within the legislation it says, well, if we have depreciable property, you're allowed to depreciate the assets. You can claim a certain percentage of the amount as an expense. And when you do that, that already reduces your income tax liability. So if we were to have a literal interpretation of this definition, that it tends to mean that when you claim depreciation as an expense, it is tax avoidance. All right. But fortunately, that's not the case. And we have I think we have many cases in the past that actually discusses tax avoidance situations. And again, we have to look at the case law and see how the judges go about it in deciding whether that sort of arrangement is a tax avoidance arrangement or not. And it has become very clear now that the general anti-avoidance rules and the specific provision within the legislation, no, they don't override. So the general anti-avoidance rules don't override the specific provision, but they actually work in tandem. So they're going to see if somebody claims an expense, which is allowed in the Act, is that within the Parliament's intention? When the Parliament first enact that rule, is it what the Parliament intended to work out in that sort of way? Right? So that's what is meant. So yes, before they explain about what this test is all about, they want to look at the arrangement, whether it's viewed in a commercially and economically realistic way, and they use the Act in a manner that's consistent with what the Parliament would have intended for the provisions that will apply for the arrangement. So very important, they want to look at the Parliament's purpose regarding the provision and the commercial reality and economic effects of the arrangement. So the facts of the case becomes very important to see whether it is caught under the meaning of a tax avoidance arrangement. So commercial reasons becomes very important. And economic effects is also important because they're not just going to look at the legal form. They're going to look at the substance. What is really the substance? What's actually happening? And based on all these indicators, they want to see whether the advantage that's obtained by the taxpayer, is it outside the contemplation of Parliament? So, as I said, sometimes it's quite difficult to tell because it's quite difficult to tell whether, well, the Inland Revenue will think that the arrangement is outside the contemplation of Parliament, or whether the judges think that it is outside the contemplation of Parliament. So as a result, the Inland Revenue has attempted to provide some guidelines as to what their views are. And they've given numerous examples of scenarios which they think whether that sort of scenario will be regarded as a tax avoidance arrangement or not. And the principles have also evolved over a number of years that the Inland Revenue themselves have actually withdrew some of the early examples which they think they haven't provided correct guidance, and they've come up with new examples which they think that should be the right thinking. And again, you find that some of the examples have also been withdrawn again and come up with new examples, right? So there are numerous guidelines that have been provided by the Inland Revenue. And if you're interested in reading them, they're all available on the website. The New Zealand Taxation Book has also provided an overview of the history of these tax avoidance rules. And they're quite lengthy. If you have no time, you can skip them But if you're really interested in this particular area, you can read them out. They have also, the NZT has also given a number of landmark cases as well, as to how the judges have changed their mind, what are the principles they use, and some of them are pretty interesting as well. And again, you don't have to read all the cases, although many of them which are raised in the book are landmark cases. You might just maybe read one or two of them, and that will be sufficient. I do have one case which I'm going to just briefly introduce you all to afterwards. Now, sometimes you find that particularly when the taxpayers wants to structure their business, as I mentioned earlier, they want to know which is the structure that will be most tax advantageous. And tax advantages, normally we think in terms of paying minimize their tax liability. But when they think in terms of structuring or restructuring, there are also other non-tax factors which are really important as well. So some commercial reasons in the case of structuring or restructuring will be sometimes people do that to protect their assets, or they do that because they're planning for their future generation to enjoy the assets that they have, right? So those are examples of commercial reasons. Sometimes they want limited liability, right? So they want to reduce the risk that's involved in the particular business. Sometimes, let's say if they are already running the business in the form of a partnership and they don't quite like this joint and several liability and they want to eliminate that. Therefore, they want to go forward and restructure the partnership to some other structure. So that is another good commercial reason which they can put forward for restructuring. And sometimes certain structures help them to raise finance easier than other structures. So these are commercial reasons. Now, if these are the commercial reasons for them to come up with a structure that they want, at the same time, you find that it might also help them to minimize their tax, either in terms of helping them to split their income to other people, or it reduces their tax liability. So the question here is, if somebody plans to restructure their business and manage to reduce their tax liability, is the restructuring a tax avoidance arrangement? Right. So under the current parliamentary contemplation test, if a case is being brought up, the judge will want to look at the commercial reasons. They will want to look at the economic effects, and they will want to see, is it outside the contemplation of Parliament? So if somebody have very good commercial reasons, they will pass that test. And if the structure is properly formed, right, there's really such a structure. If it's a partnership, right, they might have a partnership agreement drawn up. If it's a trust, they might have a trust deed that's really drawn up. So those are good commercial reasons that will support that test. And if they manage to split income because it is incidental, then it will not be considered as a tax avoidance arrangement. Or if they manage to reduce their tax because if they use a corporate structure and corporate structure tax rate is 28%, whereas let's say if their individual structure, they're already at 39%. If they change to a corporate structure where they reduce their tax to 28%, then you find that it will be regarded as within the contemplation of Parliament, because within the Act, it says a company is taxed at 28%. That's what is provided in the Act. So that is contemplated by the Parliament, that a company will be taxed at 28%, right? As long as there are good commercial reasons, right? And it has the economic effects as well. All right. Now, Penny and Hooper's case is a really interesting case because it's also a case about restructuring. And there are actually two different taxpayers here. Penny is one and Hooper is the other one, but they decide to look at these two cases together. So these two taxpayers were actually orthopedic surgeons, and these type of surgeons, well, they have the specialist skill that the amount of income they derive is really, really high. So initially what they did was they were like sole proprietors, right? They just run their practice on their own. And if they do that, that means that whatever income that they derive from their services will be taxed at their marginal tax rate. And obviously the income is really high, that they are at the top marginal tax rate. So they decided to restructure. Well, probably they seek the advice of an expert who say, well, maybe you restructure, that might be a good way to go about it. And this is what actually happens. This is the taxpayer who were initially running their own practice. What they did was they formed a family trust and they also incorporate a company. And the family trust actually owns the company. So after they've done that, what they did was they sold their practice. They sold the practice to the company, and therefore they become an employee of the company. They draw up a contract of employment. They become an employee of the company. And of course, this taxpayer will be providing all the services, all the medical practice here, and all the income will be derived by the service company. And the service company, well, from all the income they derive, will pay a salary to this taxpayer, and the balance will be distributed out to the family trust. And once it goes to the family trust, right, it can go to the beneficiaries, you can go on to buy a house, and the beneficiaries can live in the house, so on and so forth. So you can see that there are a lot of benefits for them to actually restructure. So the Inland Revenue had a look at their situation and found out that initially, when they were operating the practice on their own, their salary were as high as well, nearly $1 million. And that means they have to pay tax based on their top marginal tax rate. After the restructure, they actually became employees of the company, and their salary that was paid by the company were actually quite low. You can see the difference between the initial income they derive and after incorporation, they only receive about, well, 100 to 120K. And that is what the Inland Revenue spotted and said, wow, there is a huge savings of tax by these taxpayers. They've reduced their tax liability tremendously. And they ruled that the restructure is actually a tax avoidance arrangement. So it was brought to court, to several levels of court, starting with the High Court. The High Court says, well, taxpayers have the choice of what structure they want to use to run their business. It is all right for them to choose one structure over another. And even though you only have one shareholder in the company, it is not a misuse of corporate structure, because by law, they're allowed to have one shareholder in the company. That's fine. And it says that, well, there is a change in the tax incidence from the sole trader to the company. And the judge says this is consistent with Act. The Act provides that if it is the company now deriving the income, it will be the company paying the tax, right? Well, which is at 28%, and that is provided by the Acts. And if the business is conducted by the company, the income is derived by the company and not the individual. And the other thing is because the Inland Revenue pointed out about the salary, which is so low, the judge in the High Court says, there's nothing in the legislation that says they must pay a certain amount of salary. And I think that was what a lot of people were thinking at that time. Because what we have in the legislation is, as I pointed out to you earlier, we only have the specific provision that talks about excessive salary. It doesn't talk about, well, what's the opposite of excessive? It doesn't talk about a lower amount of salary, right? So there's nothing within the legislation that talk about they must pay a certain amount. They only talk about when they pay excessive. So that was the judge's thinking, and therefore the judge ruled that such an arrangement is not a tax avoidance arrangement. Well, of course, the Inland Revenue was not very happy with this outcome. So the Inland Revenue appealed, and it went to the higher courts, from Court of Appeal to the Supreme Court. So the judges in this higher court have a different interpretation based on the facts that was provided. It actually agrees with the High Court in terms of choice of business structure. They say, well, taxpayers are allowed to choose whatever structure that is suitable for them, right? They are agreeable on that. What they were not agreeable was on the salaries. They said the salary was far too low, below the ordinary commercial expectation. And there's no valid reason for paying such a low salary. And according to these judges, therefore, it tends to show that this is a tax avoidance arrangement. So they incorporate the company so that the company can pay them a very low salary. And therefore, they say, we accept that it is a corporate structure, but we don't accept the payment of a very low salary because it is not within the contemplation of the parliament. And therefore, in this situation, it is regarded as a tax avoidance arrangement. Now, this is another example which shows you the Inland Revenue thinking as to whether this sort of common situation, will it be caught under the tax avoidance rules or not as well? And the Inland Revenue has come up with this example to assure people that if it is in this sort of situation, it will be okay. So this example is about a taxpayer that borrows money to buy a rental property, which is let out, and they incur different types of expenses. And obviously the expenses can be used to reduce the rental income. And the expenses actually exceeded the rental income. At the time when they came up with this example, the ring fencing rules haven't come about yet. So we just assume that all the expenses are deductible, including all the interest expense are deductible. And if they derive a loss, the taxpayer actually can use it to set off against their other income. So people are asking in this sort of situation, because the tax liability has been reduced, because the taxpayer can claim the loss, is this a tax avoidance arrangement? So the Inland Revenue says, in that sort of situation, they don't see anything fishy about it. They actually did let out the property and they did receive rental income. They did incur those expenses, right, on interest on borrowings. They did pay rates, insurance, and therefore within the Act, they're allowed to claim those as a deductible expense. And if the expense exceeds the income, it will give rise to a loss. And within the income tax legislation, if there is a loss, the loss can be used to set off against the salary and wages. So even though it reduces their taxable income, they say it is such a situation is within the contemplation of Parliament, right? It reflects commercial reality and it has the economic effects. Everything will at arm's length, and therefore it is not a tax avoidance arrangement. Right, so you can think in terms of many other scenarios where more or less the Inland Revenue has assured that there's nothing fishy within. It is commercial, it's not contrived, it's not circular, right? It will not be regarded as a tax avoidance arrangement. We have covered one topic, which is on the PI regime. So people have the choice of investing in a managed funds, which is a PI, or invest somewhere else, maybe in a bank, right? Just bank deposit. And if they choose to invest in a PI, the top rate is capped at 28%. And that means they manage to reduce their tax liability. So that sort of choice will be within the contemplation of Parliament, even though they manage to save tax. If they're at a 39% tax bracket, they will save about 11% tax. That is within the contemplation of Parliament. If people invest in that way and save tax, it will not be regarded as a tax avoidance arrangement. All right, so that more or less covers this topic. Is just an overview of the tax avoidance rules, and we are not going into too much detail, especially in many of the complex tax cases. So just a reminder again, on Thursday is our revision at the same time, and Friday is Michelle's revision with you all. Assignment 2 will be returned by tomorrow, the latest. And then the suggested solutions to this assignment 2 will be on the stream site by Wednesday, the latest. Okay, so does anybody have any questions?
No questions.
Okay, no worries. I will stop the recording now. So I will see you on Thursday. Okay, bye.
Thank you.
Bye.